Hi, everyone. I'm James Garbett.
And I'm Denny Dumas.
And this is the Garbett Dumas Real Estate Podcast.
Back on the GD Podcast. Special guest, mortgage broker extraordinaire, Alex McFadden.
Thank you. Just put my glasses on so I look smarter today.
All your financing needs. He'll help you out. No, to be honest, this guy knows a ton about financing and investing and being a first-time buyer.
I do.
And helping first-time buyers achieve, it sounds a bit corny to say, the dream of home ownership, but it actually is. And owning in Vancouver is very challenging. Vancouver real estate, it continues to be more and more and more and more expensive.
Mm-hmm.
And if you are a first-time home buyer, you're probably currently renting, and rents have skyrocketed. A normal one-bedroom rent in New West is $2,300, $2,400, $2,500 a month. So we're going to talk about, like, what does that look like in a mortgage payment? What can you buy?
Mm-hmm.
And how do you qualify? And where are people getting help for down payments? And what incentives are available currently from governments to help you make this dream come true?
There we go.
First-time buyers. Let's start with where to get information.
Okay, and don't mind me picking up my phone here. I'm just preparing to calculate some mortgage payments here for you. So, because as much as I wish I had everything in my brain, there's only a limit. So
let me preface this information while you are doing some calculations with real estate, and the idea of buying real estate if you have not bought real estate before is super intimidating. It is expensive. There is a crazy amount of paperwork, especially if you're buying a strata. If you get an accepted offer on a strata and you ask for the strata documents, you're going to get a package that has like 300 pages in it. It's very overwhelming if you've never seen that as a 25-year-old or whatever, trying to understand all of this information that you've been getting thrown at you. But so back to my question of where do you go for information, Alex?
listen, we know where people typically go for this information, and that's the wrong source.
Family and friends.
I mean, that or Reddit. I don't think there's a bad thing in asking questions. You know, when I was younger and I was looking to buy my first home, I talked to my parents too, but then I quickly realized they didn't know what they were talking about, and then I didn't buy a home right away. So I blame it all on them that I didn't buy a home sooner. No, I don't, but I would have bought a home sooner if I had understood it. So I'll take that as my responsibility. And if somebody's listening to this podcast or watching a reel or anything of that nature, if there's one thing that I would take away, talk to an independent professional, someone who actually does business, who's doing a consistent amount of business, because there's a difference between somebody who's got their license and they sell a few homes a year that's probably hungry for commission, and someone who's helping out a lot of families and they run a proper business and their responsibility is to help advise you. They're going to give you probably more direct answers and it'll be a little bit less biased. So where do you get information? I mean, the good news is that you're putting out content like this, which is meant to educate people. Like, we're not getting paid to be sitting here at 7:30 on a whatever night of the week this is,
what
right?
Is it Tuesday?
Tuesday night of the week. We're here because we believe that the best way to reach people is by educating, supporting, and helping. Because a lot of this information is widely available, but I think the biggest problem is there's too much information. Where do you get started? Well, the first thing people do these days, well, it used to be Google, now it's probably ChatGPT, but it's still complex. There's so much information to weed through. And when you search for information, the interesting thing about searching on Google or ChatGPT is the information is rarely very personal. It's rarely very specific. It's just a bunch of generalities.
Yeah.
And you can go down the rabbit hole of, well, I need to know this, and I need to know that, and I need to know this. And to your point, it becomes scary, overwhelming, concerning. It's a lot of money, and I don't want to do it because it costs a lot. But what we hope people do is they get excited. Nervous excited is okay. It's a good stress, right? We get nervous excited. We have a basic plan of action, what we need to do, and they can do that today or tomorrow. And they put themselves in a position where they look at this as an investment and not a cost. And perhaps investment in the mindset of, whether it's my home that's an investment for me and I'm putting my money in a good place instead of rent, 100% interest on rent, 5% on a mortgage rate, right? But investment in the perspective of investing into something personal for themselves that they know can grow over time. So it's a change of mindset. It's a change of place. It's talking to the right people. It's asking good questions and working with people who ask the right questions of you, to determine why you're doing it.
As you are explaining all these things, I'm just thinking of so many things. But the big thing that comes out of it is, one is like, it's a really prideful moment to purchase your first home.
Yeah.
Two is it's an asset that you now own that you can use down the road to leverage out of, or to refinance, to purchase to upsize, to whatever it may be. But the idea of paying rent to me has always been uncomfortable because it's just money down the drain that isn't doing anything for me forever.
The biggest thing that I wish someone would take away if they're thinking about getting into real estate and they're younger right now, whether you're 18 or 25, is that this sort of thing, it does take time. Okay, so perhaps some people are fortunate that they can just get pre-qualified, they make enough income, they have the money available. It's not a common occurrence. Most people, they have to set a goal or talk to someone and then come back in 3, 6, 12 months to make it happen. Well, we talk about this in other parts of our life, whether it's getting in shape or something else, but we need to delay the gratification of buying a home and understand that it is not guaranteed. This is something we need to work towards. You need to work towards. But there's so many resources and people to help you make it happen. And there's so much value in doing so. And it's not a perfect situation. There's nothing perfect about buying your first home. Not the process, nothing, right? Like there's a lot of unique things that can happen or change, or market conditions or people that can get involved. But at the end of the day, if we remove that mindset of I can just turn a little knob and click a button and all of a sudden I'm buying a home and I realize that this is something I can work towards, not only is it more meaningful, but we can be okay with taking 6 or 12 months to get to that place.
Was the first property you ever bought your dream home?
If you consider a 1992 condo in a self-managed strata building in Langley City, in an area where my car got broken into 6 times in the first 6 months, and I did a complete gut job with a smoker next door, a dream home, then yes.
I think the point I'm trying to make is starting small is okay. My first place was a 1-bedroom condo in New West that was 620 square feet that cost $272,000. And 5 years later, I had $120,000 worth of equity, and I could upsize to a 2-bedroom.
There we go.
And then
it's a ladder.
It keeps progressing, right? And over time, you save more money, and your property value goes up, and you're paying down your principal, and then you have options. Then you have this asset that has equity that you can talk to someone like Alex to find out all your options of refinancing versus selling and upsizing.
Yep.
And then there's options. And then that's where a lot of people build most of their net wealth is through real estate. But getting back to first time buying and starting, you mentioned delayed gratification. This is a process. Maybe it starts with a conversation to kind of build a game plan, but it's a 24-month out kind of thing. What incentives are available to young people who have never owned a home before to help them?
Yeah, well, the neat thing is there are some new incentives now that have come out. So there are provincial incentives. So most of our listeners are probably in BC, so we can talk about BC's provincial incentives. So we have the property transfer tax exemption. You know, in Vancouver, let's be honest, a lot of properties are worth more than $500,000. So that may or may not be useful for you. And I wouldn't wait on the government to change this. But if you buy a property for $500,000 or less, you can be exempt from paying the transfer tax.
If
you're owner occupied, sorry?
If it's your primary residence.
Yeah, absolutely. It's got to be your property. Thank you for throwing it in there. Very good. And okay, so I'm making an assumption that people that are listening are probably buying this for themselves. Sure. So we could talk about investment too. If it's a brand new build, anyone gets the transfer tax exemption up to $750, same reason. Now there's a little minor exemption for the $25,000 above that. So $500 to $525, there's a sliding scale. At $525, you pay 100%. At $500, you pay 0%. So a little bit there to help you out. Same thing on the new development side. So that's a first exemption. For some people it works out in their favor. For others, they don't. I recommend people, they don't shop just to save $8,000, but if you can, awesome. Second one, of course, is the homebuyers plan. Now the homebuyers plan, the crazy thing about it, it's a federal government program. It's changed so much in the last few years. Like they've added and they've removed. There's been some good and some bad. Most recently good, FHSA.
Yep.
The brief overview is it's like a tax-free savings account that you can use, you can invest out of, you can put money in, you don't have to pay tax on it, which is fantastic. You can also use that money as a credit to your income taxes when you invest. So that money, the interest that you're using is a deduction on your expenses. That gets complicated. So basically talk to an accountant is what I'm trying to say. But you can put $8,000 a year into it up to a maximum of $40,000, and both you and your partner can both use that. Now, the best part riffing off of that is that you can also use the RRSP program, which is the ability to borrow back $35,000 per person again from your RRSP for the down payment, tax-free again. You don't have to pay for that as long as you repay that one in 15 years. Now, to distinguish the two, the FHSA program can be used in concert with the RRSP program. The FHSA, you don't need to repay. That's kind of neat. You don't have to repay it. Whereas the RRSP one, you do. But if you use those together, you got virtually, well, I mean, I guess if you buy in like 5 years, you've got about $75,000 of additional money that you can use for down payment that's essentially been not been taxed, which is fantastic. Because at the end of the day, sometimes it's not about making more money, it's about paying less tax, which is key. So what did I say? Those two. There's also the, I don't even know what they call this one anymore. What is it? The Home Buyers Down Payment Program. Do you remember the name of that one? I'm blanking on it.
Is this the one that the government will match up to 5% or something like
yeah,
that? And they'll own 5% of your house?
Yeah, it's another one. So listen, I've literally ever only seen 2 people qualify for this program.
Interesting.
And so one of the challenges, and so please don't ask me to quote all the details of it because I don't remember them all on the top of my head, but I can tell you a few things. Essentially, why it got people excited in the first place is because they thought the government was increasing their down payment to help them qualify for a larger priced property. But what in fact it does is it reduces your loan by the amount of your down payment. So we'll use a purchase price of $400,000. I guess you're going to Chilliwack, but we'll use a $400,000 purchase price. If you were to buy a home for $400,000, you put 5% down, that's $20,000. If you qualified for this particular program, the government would lend you $20,000 interest-free, okay, in exchange for 5% equity in your property. Now you do have the ability to repay that loan. So if you repay that loan, you've paid off the government. They no longer own a piece of the equity in your home. If you're buying a new development property, then you can do up to 10%. Okay. So you can take 10% maximum, up to a maximum of 19.9% down payment because it has to be an insured mortgage, which is less than 20% down. So they'll match it. But again, what they're doing is they're not increasing your down payment. They're reducing your loan amount. So your purchase price remains the same. And so a lot of people, they thought the program was going to increase their purchase price. British Columbia had a program back in 2016-17, which actually I thought was a great program. I used it a ton for people. And it was, they would match your down payment. So you had to have 2.5% down payment, and they would match you to get to 5%, to get the minimum down payment requirement, to get to your total amount. That program, in my opinion, was a huge success. I can tell you for a fact, I helped probably 30 to 40 people at the time get into homes that never would have gotten into homes when they didn't have enough money for the down payment, but they qualified because they had good income and good credit. Perhaps they didn't have enough time to save up the money. I would love to see a program like that come back into existence for people, or the ability to, increase their purchase price or something like that. I think it would be useful if they tweaked the current program.
What was the repayment of that program? So let's say I put $20,000 down for my first place. The government matches it, gives me another 20. How do I pay that back?
Yeah, you can pay it back when you refinance your loan. So you can pay out of your existing loan if you have more equity. So if you had equity in your property, you could repay it at the time that you've exited the loan. Okay. Or if you sold your property, you could just repay the whole amount as well.
But it's interest free for...
So let's talk about the government program is interest free. I don't remember what the other one was off the top of my head, but the government program right now, the federal one, it is interest free. So 0% interest on that. So that is nice. On a 5% interest rate, if you qualify for this program, there's some value in not paying interest on $20,000 for sure. So again, one of the challenges, and they did kind of rejig this in Vancouver, was that, if you had more than, if you had more than $120,000 income, you can qualify for the program. So obviously, if you're trying to buy a house in Vancouver or a condo in Vancouver, that's going to make it pretty difficult because most people that buy a condo here, as a couple, they have more income than that, right? And the second thing is they had a limitation on the maximum purchase price at four times your income. Right. So those were the two challenges. They've rejigged it a little bit and opened it up a little bit more, but with the house prices obviously increasing, it appears that it doesn't really work in a lot of major cities still. More of the suburbs and so forth. So it might work for somebody who's listening to this. So it's good to learn about. And I would say definitely go through the rules and regulations on the government website. Of course, we would double check and go through that with a client if we're having this conversation. But the short version is that this program hasn't been a major success because ultimately there hasn't been a lot of use for it in most urban areas. In rural suburban areas, there have been more uses. So again, further you go east, if you're in the Fraser Valley or if you go to the Okanagan, you've seen more people use these programs because the cost of the cost of buying real estate has been lower. Entry level price points, maybe around $300,000 or $400,000 instead of $600,000 to $800,000.
We've referenced it a couple times, but I think it's important to clarify. There's a common misconception with consumers that you must have 20% down to buy a property.
That's wrong.
This is false. The minimum down payment for a owner-occupied home is
5% of the first $500,000 and 10% of anything above that. So if you're purchasing a property that's $500,000, that's $25,000. If it's $800,000, we'll go ahead and take 5%, which is $25,000. $300,000 more, it's $30,000. So total down payment of $55,000.
10% up to $1 million.
Up to
above $1 million.
$999,999.99. You cannot be a penny over that. It can't be. No, I'm not joking. If the contract comes in at $1 million, you need 20% down. So make that penny count.
I think this is a really important thing that we discuss with first-time home buyers because they feel like they're struggling to get to this 20% down number, and they don't understand that they don't have to.
So I want to talk about that because most people that I talk to, as you mentioned, that are first-time buyers, still believe that maybe they don't believe that you have to put down 20%, but they believe it's the right thing to do and it's their responsibility to make sure they get 20% down. Otherwise, they're throwing away their money. And I mean, obviously, there's a lot of reasons they think that because they're paying for insurance, because their parents have told them it's a waste of money, one thing or another. They've heard rumors. Again, they're probably on Reddit. But the reality is if you get into the market with 5% down payment on $25,000 and $500,000, if you hold that property for 5 years, there's a much greater probability that that property value goes up by even 2.5%, 3% appreciation annually, netting you $50,000 to $75,000, $100,000, than that $20,000 of insurance cost negatively impacting you. Yes, you have a sunken cost in the insurance expense. Basically, that's something that you're never going to get back. But the reality is you're going to build $75,000, $100,000, $150,000 in equity. Case in point, 5 years ago, 2018, if you bought a condo in Langley, what was that 2-bedroom condo worth roughly?
$425,000.
Okay. Probably even less.
Maybe less.
420. Let's say 425, a nice one. What could it be worth today?
$700,000.
Easy. Willoughby, Langley, $700,000, $750,000, somewhere in that ballpark for a nice 2-bedroom condo. Mm-hmm. That's 5 years. That's probably, I don't even know if that's an extreme example. That's a real example. Yep, so totally. That's $250,000 of equity. Someone would have bought that $425,000.
That's what I said. I was just
somewhere in that ballpark.
Guessing,
whatever.
Yeah.
They're putting basically less than $25,000 down payment to buy that property, right? And now today they've got $300,000 of equity.
The thing about the insurance premium as well is, let's say $20,000 because that's the number you threw out there. It varies based on how much you put down.
Yes.
So if you put 5% down, your insurance premium is going to be more than if you put 18% down.
Yes.
Let's say $20,000. What is a normal rent for a 1-bedroom right now? $2,500 a month, roughly.
Yeah.
In Port Moody, in New Est, in Burnaby, it probably is more like $2,800 a month.
Yep.
That $20,000 goes away in rent in 8 months, 9 months.
Yeah, it's gone.
See you later.
Yep.
The other thing to note is you're going to pay less interest because your interest rates are lower on an insured mortgage than a conventional mortgage.
True.
A lot of consumers don't understand that.
Yeah.
What is the difference, roughly? Give me a ballpark. It doesn't need to be exact, but between a insured mortgage versus insured mortgage means less than 20% down. Conventional mortgage means 20% or more down, just to clarify.
Spreads change over time. A spread is the difference between two rates. Okay, they do change over time, but today your floor, let's say 5-year fixed mortgage, not going to suggest this for everybody, but your floor is probably like 4.34, sorry. And most of the charter banks right now are advertising rates in the high 4s, so like 4.94, 5%. So that's like a 65-point spread right now in interest rates. Now, sometimes it's greater than that. Sometimes it's not. It depends on where pricing it is at any given time. Mm-hmm. But let's just say your average spread is about 0.5%. So it's a 0.5% reduction. Okay. So that I guess we'd have to do a lot of calculations to how much interest, how much principal, because it depends if you did 25 or 30 year. But short version, for every $100,000 you're borrowing, that's roughly about $15, okay, for every 0.25%. So that's $30
per month.
$30 per month,
Yeah.
right? For every 100 grand, if there's a 0.5% difference based on a rough estimate of those rates. So 3 times 400 grand. So we're borrowing $400,000 a day. Is that what we're talking about?
Yeah. So $30 a month per 100 grand times 12 times 5 years. So per $100,000, you're saving $1,800 per year. So if you have a $500,000 mortgage, that is a $9,000 saving if you are getting a better rate because you're putting less than 20% down.
Mm-hmm. Yeah, there's some variances, but that's a pretty close approximation. And I think the reality is, in most circumstances, people are putting down less than 20% because they don't have a choice. Now, let's play the devil's advocate. If you have 20% down, it's actually better to avoid the insurance at that point for a variety of reasons. One, you will actually save more money in the long run for not having paid the insurance, and you can do things like a 30-year amortization, a HELOC, all sorts of different things. But your point is well taken. The fact is there is an interest saving, so there is some benefit, and that whole expense isn't necessarily in the toilet, so to speak.
Exactly. That was my point, is that if you're looking at that $20,000 insurance premium as money down the toilet, consider the interest savings, consider the savings on that you'd be paying in rent for that next year. Or,
equity, man.
If you're paying $2,500 in rent over a 5-year period, quick.
While you're doing those numbers right now, let's come back to that really quickly. I want to share.
It's $90,000 in 5 years.
There you go. Boom. A lot of money. I shared a graphic in a presentation I do for first-time buyers. We do the second half of our conversation. We do a brief presentation, and one of the graphics is about equity growth. And I used an example. Again, I used $1 million property. They're probably spending about $500,000. But for the sake of conversation, we do $1 million property, and this property over the course of 5 years appreciates by 2.5%. So way less than really what's going to happen. But just to be conservative, 2.5%. That property, $1 million, is now worth 1.13. Okay? That's what it's worth based on 2.5% appreciation. On top of that, now, again, this part's harder because it depends on where rates are. But in the example I used, I built this out when rates were 3.5%. You paid down almost $100,000 off the mortgage over the course of 5 years. Okay, so you're paying off your loan, even if we said conservative, $75,000, but you're still paying off a fair chunk of change as opposed to rent. So call it $100,000 because that's what it is, and we got 1.131 value. So bring it all back together, we got $230,000 of equity gain plus a down payment that you put into the property in 5 years. Right, so that's pretty significant. All of a sudden, you have your money plus that money. You got $430,000 of additional equity in your property. Huge. So again, I think it's probably easier. The podcast folks might not be able to see this, but what I'm trying to get to is that there's a lot more to it than just paying for the insurance. So let's get that mindset from cost to investment. You're making an investment. It's like, I'm going to go on this. You hire a personal trainer. It's not a cost for a personal trainer. It's an investment in your health. And that's important to recognize because it's not like you're throwing it down the drain trying to buy, I don't want to put anything terrible on the table here, but something that's
like
useless.
A boat. Like a boat.
On a boat. Yeah, there you go. You're not just trying to buy a boat or something unnecessary, but you're putting it into something that's going to help you improve. So that's always an investment. So buying a house, it's going to put you in a better personal position, financially speaking. So it's an investment. So we need to get our minds wrapped around that.
If you're a first-time buyer, seek knowledge from the professionals. Dad, who has been a high school teacher for the last 3 decades, probably is a great dude. Great dude. Really good dad. Coached all your sports teams, but is not the right person to seek investment real estate advice from. If you are a first-time buyer and you want to get in the market and you have questions about lending, chat with this guy here, Alex McFadden at Flow Mortgage Co.
Thank you.
And call the GD team because we are awesome and we work with a lot of first-time buyers and we'd like to work with you.
Let's go.